Welcome back. This is part two of business combinations. A couple of other reasons you may have a merger. Purchase of assets at below replacement cost. You can buy a company and you may get the assets cheaper than you could replace them. Breakup value. The assets more value if broken down and sold to other companies. Acquire other firms to increase size, making it difficult to be acquired. And in some cases, utilization of tax NOLs. That if there is tax losses, they can be carried forward and offset future income. So there's value. And continuing on, a leverage buyout, LBO. What's that? We often hear that term. And what that is a company is publicly traded today, and there's probably a family may own a significant portion, management may own a significant portion, and what they do is they buy all of the publicly held stock up, and it's no longer publicly available. And this is often financed with debt. Reason for doing it is you can focus on a longer term outcome other than just the past quarter. So it oftentimes gives a firm an opportunity to restructure, fix things, introduce new strategies, and build it back up. And it's financed with debt. Now, after operating privately a number of years, investors go back and take the firm public to cash out, to see the impact of their longer-term investment. And they want to grow the company. They're not worried about short-term earnings, which publicly held companies are. Oftentimes, investment bankers are involved in merger-related activities, and that includes acquisitions. They identify targets, arrange mergers, develop defensive tactics, establish a fair value. How much is the value really worth? They help in the financing of mergers and acquisitions and arbitrage operations. Arbitrage essentially is they will buy a piece of the company with the intent to sell it, okay, and make a profit on what they can buy it for and what they can sell it for. So these are the things the investment bankers do around these type of activities. And most publicly held companies, when this is engaged, there's always an investment banker there. Now let's get on to the real meat. Sometimes you need to understand the background before we can talk about the financial reporting. The balance sheet impact, you have an acquisition of assets and assumptions of liabilities. There's then the funding impact, meaning that if you had to borrow money to pay for it, cash flow statement reflects the impact of the cash flow from the acquisition. So it comes into cash flow from operations, cash flow from investing, and financing. And the income statement impacts different lines on the business, on the income statement, but there's also a funding cost. That becomes key. Let's come back. What is the purchase price? Because that's where we're starting. What a willing buyer and willing seller are willing to pay. The seller is assuming that the price that they're going to receive produces an appropriate return on their investment since they had it, and what they think the firm, its assets, are worth. Now, these can be tangible assets, intangible assets, the ability to generate an exceptional cash flow into the future. Willing buyer, they're looking for an acceptable return on their investment too. Will those assets produce a premium future cash flow and a terminal value? Generally, the buyer believes there is some form of synergy on the combination. Going back, it's either going to develop the business, expand the market, the products, the offering. It's either going to be a finance. So we're looking at that purchase price, and it's a negotiated price. Okay? It's all negotiated between the parties. Now, next question is, well, okay, come up with the purchase price. And how's the transaction paid for? A number of different ways. 100% paid in cash by the buyer to the seller. That means the company would use its own cash and pay outright for the company. It's been done. Sometimes they're paid in stock. We'll give you 100 shares in our company, and we'll acquire the stock by paying in stock. In this case, the seller values the synergy and is still engaged and invested in the business, just in a different position. Okay? And that increases the equity of the combined entity, the equity of the combined company. Issuance of debt by the buyer to the seller. It can be seller financing, it could be third-party financing. It could be a mix of cash, stock, and debt. And oftentimes, that's what it is this mix. So it's paid for in one of these ways. Understanding how it's paid for becomes important, and we can find all of that on the cash flow statement. Where do the funds come from if you keep going? Cash. You got cash in the bank. Got marketable securities. They're not used in the working capital cycle. Cash flow from operations. Issuance of debt. We issue new debt, take on liability. We could issue new stock. And as I said, this can be found in the cash flow statement with details in the management analysis and note section. When we have one of these, it takes us to dig deeper to see what it is. And in this case, this happens to be SDLD, my favorite company. And what you could see here is acquisition of business net of cash acquired, $433 million. Okay, so where did that cash come from? Well, let's back up and say cash flow from activities was $1.4 billion. So cash threw out a lot. When you look at the issuance of debt, repayment of debt, they didn't issue new debt. They bought back stock, they didn't issue stock, and they paid dividends. So they didn't use any equities. So they had to use cash. And cash flow from operations, and they used a piece of the cash that they had at the beginning of the period. So by going through the cash flow statement and looking at those lines, we can determine how it was paid for. This would be a great question for the quiz. How do you record the transaction? Well, accounting guidance is provided in ASC 805 and 820. Cash and cash equivalents are valued at the face amount. Marketable securities at the market price. Remember, there's marketable securities and then there's illiquid securities. Marketable securities are those that are traded on some form of exchange, and you can liquidate them fairly quickly. Then there's illiquid, and we follow ASC 820 fair measurement. Then we have inventories, market value. Prepaid expenses, that's like your insurance you paid in advance, at face value. Property, plant, equipment, fair market value, appraisal by a third party. Liabilities come across, if you assume liabilities, at face amount. Here's a little bit of what was, Okay, so the next thing is we have the purchase price. We take off, we identify all the things we identified here. Okay, all of this. We subtract that from the purchase price, and that leaves an amount left over. Those are intangibles to be valued. We're paying more than the fair value of the tangible assets. That can be for trademarks, knowledge of the company and the firms, brands, goodwill, patents. So the first step, once we find out the excess of the purchase price over the fair value, is we value the intangibles. Now, intangibles are governed under ASC 805. They're identifiable intangibles. You can touch them, put them in a specific bucket. And they're in the marketing field, customer-related, artistic, contract, and technology. Looking through them, trademarks, marketing-related, trademarks, trade names, trade dress, mastheads. Anybody want to guess what the masthead of the Washington Post is? Democracy dies in darkness. Non-compete agreements, customer-related, customer lists, backlog, contracts. Then there's artistic, plays, operas, books, musical works, pictures, videographs. Okay, so these have a value. Contract-based, you have a license, royalty. Contracts, lease agreements, franchise agreements, broadcast rights, employment contracts. So each of these are identifiable and a value can be determined. So the first thing we do after we do the fair market value of tangible assets, we value intangibles. And if we go and take a little look at IFRS, business combinations, if an intangible asset is acquired in a business combination, the cost of that intangible asset is its fair value at the date of acquisition. The fair value of an intangible will reflect expectations about the probability that the expected future economic benefits will flow to the entity. That gives us a little bit more than we might see within ASC 805 and 820. So once we do that, we have what's left over. If we subtract that is goodwill. And this is a concept. So we've done here's the purchase price. We're taking away the tangible assets. We're taking away the identifiable intangibles, and that is goodwill. And that's the expected economic benefit over a period of time. It's not individually recognized or separately recognized, but it's there. Now, here we take a look at Heartland, which was purchased by Steel Dynamics, and initial cash purchase price of $396 million. On adjustment based on working capital, because you don't know. It tells you what they do and what's happening with it. So let's keep coming back here, because this is where we come into the goodwill. Goodwill equals the purchase price less fair value. It exists because great profit margins coming, exceptional future growth prospects, major competitive advantage. So that is a picture of that. When we look at fair value measurements, we have, this is from ASC 820, unadjusted prices, active markets, quoted prices, they're observable, but they're not traded. And then level 3, derived from valuation techniques, which have a number of significant inputs, assumptions. Okay. As we keep going, here is it shows us originally, let's start with the adjusted, because they made an initial report. Then there was adjustments through closing and adjusted. So they got current assets, net of cash, 123, property, plant, and equipment, 319, intangible assets were 41,200 identified, and goodwill of 46 million. So the assets acquired were 530, net liabilities assumed 96, and net assets acquired of 433. And they discuss how they valued those. Okay. And you come down here, goodwill recognized from the acquisition primarily relates to the expected contribution to the overall strategy in the acquired workforce, which is not separable from the goodwill. It's not deductible for tax purposes. And the identifiable intangibles, they're saying have an estimated life of 15 years. So that's how Steel Dynamics has done that. Then a company goes in on an annual basis. Those that are intangible and have a life are amortized, okay, and they revalue them and make an adjustment if there's an impairment of value. And that is, they do that on an annualized basis, and whenever we have goodwill, we need to take a look at this. Now, take into account, you're going to see a presentation on Kraft Heinz, which acquired companies put businesses together. They had a lot of goodwill. They reevaluated them this year before they issued their 12/31/2018 statements, and they had to write off a significant amount. So whenever we have goodwill or other intangibles, we need to look at this on the, these are in the notes to the financial statements. Here they summarize the actual goodwill and intangibles, and here they break it down as to what the goodwill is by business that they bought. Okay, and they go through the key assumptions. You can read this, but